And we may be just a few months into 2012, but our next guest says investors are already worried about 2013. Michael Darda is the chief market strategist at MKM Partners, joins us from Stamford, Connecticut. Also, Julie staying with us, and Josh now coming into the picture. Michael, you say, is this right that you've gotten panicked phone calls from investors talking about 2013?
Well, not necessarily panicked phone calls, but there's certainly an air of panic in some of the discussions that we're having with clients and investors about some of the fiscal uncertainties associated with 2013. You have the Bush tax cuts expiring. You have other temporary tax provisions under the Obama administration either expiring or coming on regarding health care reform. And the sequester budget cutting that's also potentially on the table. So there's a lot of fear associated with the so-called fiscal cliff in 2013. Personally, I'm not as fearful as the consensus, but it is a focal point.
But what's driving that? Has anything precipitated this? Because these are sort of just, factors that have been overhanging the markets for quite some time.
Well, I mean, I think that, it's part and parcel of Congress really not either being able or willing to do its job and to deal with some of these issues in advance. And so if they end up piling up and then have to be dealt with next year, the concern is that we could have a multi-month period of uncertainty where the market is restrained as a result. So it would be nice if Congress could look forward and act in advance to head some of this uncertainty off, but then again, it's Congress.
Right, I was going to say it's Congress and it's Washington and it's election year. Well, we are back with more from Michael Darda, the chief market strategist at MKM Partners, joining us from Stamford, Connecticut. Julie and Josh here as well. And Michael, just extending this out to sort of more of the broader markets and what you're seeing here with this equity rally. You disagree with some of the strategists that we've had on who say, look, watch out, we may be in for a correction here from this rally. Why don't you see that risk?
Well, certainly that could happen. I just think it's such a prevalent concern virtually everywhere we go, or, reading any media outlet or listening to financial television, you hear many strategists predicting an imminent correction. And I think there's a lot of fear associated with what happened to the stock market last year during the spring and summer into the fall, and in 2010, where the market peaked in April and then sank into the summer months. So there's a bit of a sort of a Pavlovian reaction function going on. But simply because that occurred last year and the year before doesn't mean it's a done deal. Now, it wouldn't be surprising to see the market flatten out and consolidate here for a while after this big run, but I would just say, be a bit leery of these consensus views that start to get hardened into the financial lexicon.
Hey, Mike, at the same time that we're seeing people worry about an end or at least a pause in the equity rally, they're also quite concerned about a pause or an end in the bond rally. And it seems like that both views can't necessarily be right. So if you think that maybe we'll just have a flattening here and that'll be it, do you think that the bond rally can keep on going?
Oh, I hope not. Probably you wouldn't see a huge further bond rally unless it looked like the U.S. economy was tipping back into a recessionary situation or that deflationary concerns started to mount. So I think we certainly would not want to see bonds continue to rally. That doesn't mean that interest rates are going to rise in a dramatic fashion. I sort of think bond yields are going to be in a fairly low range for a long period of time, but will tend to move with cyclical fluctuations in the U.S. economy and economic growth expectations. Recently, bond yields have moved up a bit, but they're still incredibly low on a historical basis and really at the lower end of the range we've seen over the course of the last 4 years.
Yeah.
Hey, Mike, it's Josh. A question for economists. The big question is about that mild winter weather we had, and some skeptics argue that really distorted the data. It exaggerated the strength of the U.S. economy when it comes to jobs and retail sales and manufacturing. What's your take on that?
Well, I think there could be some distortions there, but I don't think it's the whole story. We've seen a lot of other very important indicators for cyclical fluctuations in the economy improve. Financial conditions, credit markets tightened up and deteriorated a lot last year. That's reversed. There's absolutely no way that has anything whatsoever to do with the weather. That said, the warm weather probably did have some impact on seasonals, perhaps for the housing data, but probably also worked the other way with certain consumption expenditures that would take place in the winter months that didn't. So I think there could be some distortions there, but certainly not the whole story.
So, Michael, then, getting back to the markets and to your target, your S&P target is 1425. And how likely could we, in fact, actually pass that target then?
Well, I think more likely than not. My view is I don't really believe in targets. Targets are sort of put out there to be broken. My guess is that we probably grind higher into the fall, and then the market stalls close to the election as this 2013 uncertainty starts to become more of an issue. And ultimately, I think it'll be resolved in a relatively positive way. I think there's at least a 50-50 shot, if not a little bit better, of a broad-based tax reform next year. That would be the right way to deal with the expiring Bush tax cut provisions and the concern about fiscal deficits and so forth. So, I think ultimately we could be at new cycle highs sometime early next year, but probably with a pause around the fourth quarter of the year.
Okay, all right. Well, there you go. The view on the markets there from Michael Darda. Thank you so much. Great
Thanks.
to talk with you, Michael. Michael Darda of MKM Partners.